You are 52 years old, sitting across from your spouse of 25 years at your favorite restaurant, and she just said the words you never thought you would hear, "I want a divorce." You built a business worth $3 million. You have got a $401,000 with $1.2 million in it. Your home is paid off and worth $1.8 million. And in the next 18 months, you are going to watch half of everything you spent 3 decades building get divided up in a courtroom. Unless you know what the wealthy know about protecting assets before this conversation ever happens. My name is Leo, and I spend way too much time thinking about asset protection strategies that high net worth individuals use to divorce-proof their wealth. If you are someone who has spent decades building wealth and you want to make sure a gray divorce does not obliterate your financial future, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here is the thing. Gray divorce, which is what they call divorce after age 50, has more than doubled since 1990. According to Bowling Green State University research, the divorce rate for people over 50 has increased by 109% over the past 3 decades. And here is what most people do not realize. Gray divorces are financially catastrophic in ways that divorces in your 30s are not. Look, when you get divorced at 35, you have got time to rebuild. You have got 30 years until retirement. But when you are 55 and you split assets 50-50, you are trying to retire on half the money you planned for, with maybe 10 years left to save. A study from the National Center for Family and Marriage research found that women over 50 see their household income drop by 45% after divorce. Men see a 21% drop. But it is not just about income. It is about accumulated wealth getting cut in half right when you need it most. Now, you might be thinking, well, I would just make sure everything stays in my name. That is not how this works. In community property states like California, Texas, Arizona, and 7 others, anything earned during the marriage is split 50-50, regardless of whose name is on it. In equitable distribution states, which is most of the country, the court divides things fairly, which usually means close to 50-50 for long marriages. So how do wealthy people protect themselves? Let me walk you through the actual strategies, not the stuff you hear on social media, but the stuff that holds up in court. Strategy number 1, prenuptial agreements. I know. You have been married for 20 years. A prenup does not help you now. But here is what you need to understand for the future or for your kids. A properly structured prenup is the single most powerful asset protection tool that exists for marriage. And the ultra-wealthy do not think of prenups as planning for divorce. They think of them as business arrangements that clarify property rights. But what if you're already married? Postnuptial agreements. Same concept, different timing. Now, courts scrutinize postnups more carefully because there is a presumption that one spouse might have leverage over the other. But they absolutely hold up when done correctly. The key is both parties need independent legal representation, full financial disclosure, and the agreement needs to be reasonable. You cannot write a postnup that leaves your spouse destitute. Courts will throw that out. Strategy number 2, asset protection trusts. This is where it gets really interesting. Trusts are not just for passing wealth to your kids. They are tools for protecting assets during your lifetime, and wealthy people use them aggressively. Domestic Asset Protection Trusts, or DAPTs, are legal in 19 states. States like Nevada, Delaware, and South Dakota have built entire industries around these trusts. Here's how they work. You transfer assets into an irrevocable trust. You can be a beneficiary of the trust, meaning you can still benefit from the assets, but you no longer own them legally. Because you do not own them, they are not part of your marital estate in a divorce. Now, the really wealthy go a step further. Offshore asset protection trusts. Cook Islands, Nevis. These jurisdictions have laws specifically designed to protect assets from U.S. judgments, including divorce judgments. And before you say that sounds shady, it is completely legal. You have to report it to the IRS. You pay taxes on any income, but the assets themselves are outside the reach of U.S. courts. A Cook Islands trust, for example, does not recognize foreign judgments. If your ex-spouse gets a divorce judgment in California, the Cook Islands trustee does not have to honor it. Strategy number 3, business entities. If you own a business, how it is structured matters enormously in divorce. An LLC with a properly written operating agreement can restrict the transfer of ownership interests. This means that even if a court awards your spouse half of your business interest in a divorce, the operating agreement can prevent them from actually having control or forcing a buyout. Family limited partnerships work similarly. You transfer assets into the partnership, you retain control as the general partner, and you gift limited partnership interests to family members or trusts. Limited partners have no control, and the interests are hard to value and harder to liquidate. Courts hate trying to divide these in divorce, and often the non-owner spouse ends up with a cash settlement instead of actual ownership. Strategy number 4, life insurance trusts. High net worth individuals use life insurance in ways most people never think about. An irrevocable life insurance trust, or ILIT, owns a life insurance policy on your life. You do not own it. The trust does. This removes the cash value and death benefit from your estate for estate tax purposes, but it also removes it from your marital estate. Here is the thing, though. The trust has to be irrevocable, and it has to be set up correctly. If you retain any control, any incidence of ownership, the IRS and divorce courts will pull it back into your estate. But when done right, you can have millions in life insurance that is completely protected. Strategy number 5, retirement account titling. This one surprises people. Your 401k and IRA are not automatically protected in divorce. In fact, retirement accounts are often the biggest marital asset that gets divided. But there are ways to protect portions of them. First, any contributions or growth that happened before marriage are separate property in most states. The key is documentation. You need statements showing the balance on your wedding day. Second, inherited IRAs are separate property if you keep them separate. The moment you commingle an inherited ARA with marital funds, you have lost that protection. And third, understand QDROs, Qualified Domestic Relations Orders. This is how retirement accounts get divided in divorce. A QDRO lets your ex-spouse take a portion of your 401k without the 10% early withdrawal penalty. But here is what wealthy people know. You can negotiate the QDRO terms. You can structure it so they take their share now and you keep the future growth, or vice versa depending on market conditions. Strategy number 6, real estate titling and LLCs. If you own rental properties or investment real estate, never, and I mean never, hold them in your personal name if you are worried about asset protection. An LLC provides liability protection, sure, but it also complicates divorce proceedings. When real estate is held in an LLC that is structured as separate property, maybe it was funded with inheritance money, or it was purchased before marriage, it is much harder for a spouse to claim a community property interest. And here is something most people miss. How property is titled matters more than anything. If you bought a property before marriage with separate funds, but you put your spouse's name on the title after marriage, congratulations, you just transmuted separate property into community property. I see this all the time. People think they are being nice, adding their spouse to the deed. What they are actually doing is giving away half their separate property. Strategy number 7, keeping separate property separate. This sounds obvious, but it is where most people screw up. Separate property is anything you own before marriage or inherited during marriage. It stays separate as long as you do not commingle it with marital funds. Let me give you an example. You inherit $500,000 from your parents. You deposit it into a joint checking account with your spouse. You just commingled it. It is now marital property. But if you deposit that $500,000 into a separate account, In your name only, never add your spouse, never use marital funds to pay fees on the account. It stays separate. The same goes for businesses. If you started a business before marriage, but you used marital funds to grow it, or your spouse worked in the business, they now have a claim to some of the value. Keeping things separate requires discipline and documentation. Strategy number 8, forensic accounting documentation. Wealthy people document everything. And I mean everything. Every source of funds, every transaction, every account. Because in a divorce, especially a high net worth divorce, both sides hire forensic accountants to trace assets. If you cannot prove that money came from a separate property source, the court will assume it is marital property. Here's what most people do not realize. The burden of proof is on you to show something is separate property, not on your spouse to show it is marital property. So you need bank statements, you need account statements, you need transaction records going back decades. I'm talking about keeping records of the balance in your retirement account on your wedding day, keeping the appraisal of your house from before you got married, keeping the brokerage statements showing your investment account balance before marriage. Now, let me tell you what not to do. These are the mistakes I see over and over. Mistake number 1, hiding assets. Do not do it. It is illegal. It is called dissipation of marital assets, and when you get caught, and you will get caught, the court will punish you severely. I have seen judges award the entire value of hidden assets to the other spouse as punishment. Mistake number 2, transferring assets to family or friends before divorce. Courts can and will reverse these transfers as fraudulent conveyances. There is usually a look-back period of several years. If you transfer your rental property to your brother 6 months before filing for divorce, that transfer is getting reversed. Mistake number 3, thinking your spouse does not know about your assets. In discovery, everything comes out. Every bank account, every investment, every piece of property. Your spouse's attorney will subpoena records from every financial institution you have ever mentioned. They will hire a forensic accountant who will trace every dollar. Here is the thing that nobody talks about. The psychology of this stuff matters as much as the legal structure. Wealthy people do not wait until there are problems to set up asset protection. They do it early when things are good and they frame it correctly. It is not about planning for divorce. It is about sound financial planning. It is about protecting the family from lawsuits, from business risks, from estate taxes. Asset protection just happens to also protect against divorce. And they have these conversations with their spouses from a place of transparency and partnership. Look, we have built something significant. Let's make sure it is protected for both of us and for our kids. That is a very different conversation than I want to postnup because I do not trust you. So what do you do if you are watching this and you are sitting on significant assets and you are worried? Here is your action plan. Step 1. Get your documentation in order right now. I mean today. Pull every statement showing account balances from before your marriage. Get copies of any inheritance documents, gift letters, anything that establishes separate property. Put it all in a safe place, multiple copies, including digital copies. Step 2. Talk to an asset protection attorney, not a general practice attorney, not your buddy who does estate planning, an attorney who specializes in asset protection. Every state has different laws. Some strategies work in some states and not others. You need someone who knows the specific rules in your jurisdiction. Step 3. If you own a business, get a formal valuation done now. Not when you are in divorce proceedings now. You want a clean, defensible valuation done when there is no dispute. This establishes a baseline. Step 4. Review the title on every significant asset you own. Your house, your rental properties, your brokerage accounts, your business interests. Make sure separate property is titled correctly and has stayed separate. Step 5. If you are in a position to do prenuptial or postnuptial planning, have that conversation. I know it is uncomfortable. But you know what is more uncomfortable? Losing half your wealth in divorce court. Look, here is the reality. Gray divorce is financially devastating if you are not prepared. A 55-year-old splitting assets 5050 has to retire on half the money with half the time to make it up. The math does not work. But wealthy people do not let that happen because they plan ahead. They use trusts, they use business entities, they keep documentation, they structure ownership correctly. And most importantly, they do it before there's a problem. Because once you are sitting in that restaurant hearing those words, it is too late for most of these strategies. So do not wait. Get your asset protection plan in place now. And if this video helped you understand how the wealthy protect themselves, hit that subscribe button, give it a thumbs up, and drop a comment letting me know what financial topic you want me to cover next. Because at the end of the day, protecting your wealth is not about being pessimistic about your marriage. It is about being realistic about risk management. And that is something every high net worth individual needs to take seriously.